Okay, now it's 10:01 and let's get started. My name is XIONG Zheng and I'm very happy to be today's host for the ABFER meeting on capital market development, China and Asia. And for today's talk, the title is the Mandarin Model of Growth. Our speaker is Zheng, so Michael Song from Chinese University of Hong Kong, as well as a senior fellow of the ABFER. And our discussant is Professor Loren BRANDT from University of Toronto. And I also want to tell everybody about the timeline. The presenter has 25 minutes, and the discussant has 25 minutes, and then we have 20 minutes for Q&As. Now, Michael, you can start.
Okay, so thanks a lot, Xiaoyan, for the introduction. Do you see my slides?
Yes.
Okay, great. So first of all, let me say a few words about the history of the paper. Some of you may have seen an early version of the paper, which was single-authored by XIONG, who is also in the audience today. And then he wanted paper to be a bit more macro and more quantitative, so that's why he asked me to join the project. So it took us for like 4 years to be here. So I hope the long journey is worthwhile. Let me start the presentation by showing you a cross-country comparison of income growth. So we know China had fantastic economic growth since the late 1970s. And in this paper, we're going to focus on the period starting from 1993 to 2022. In the first half of the period we studied in this paper, China really had remarkable growth. So in this figure, you can see based on like 180 countries for which the World Bank has GDP data. The horizontal line is like the initial GDP per capita for each country, and the vertical line is income growth during this period of time in 1993 to 2007. And China is really an outlier in terms of growth. So it's actually beyond the prediction interval. So in a way, the paper is trying to study the following question: to what extent this remarkable growth in this golden period can be explained by some unique Chinese institutional features. So we're going to show you, well, actually, later you will see if what we call the Mandarin system is gone entirely, then China will become a actually normal country instead of a stellar growth country. But equally remarkable thing is after 2008, a lot of things have been changing. So the left panel in this figure is telling you what the black bars are GDP growth rate. GDP growth rate is going down. The white bars are capital growth, which is also going down, except for the period starting from 2008 to 2012. We know in that period that the capital growth was largely driven by the stimulus package. And taking that out, you see GDP growth is going down, capital growth is going down, and in the right panel, you see kind of equally striking difference. And TIP growth is also going down a lot. Actually, in more recent periods, the TIP growth was just half of its peak level. Loren has two excellent papers on that using firm level data, just reinforcing this view that TIP growth became much slower recently. In this paper, we're not going to talk about too much TIP growth. Mostly, we are going to assume exogenous TIP growth. However, in some of the slides you will see towards the end of the presentation, we will try to say something about how the Mandarin system might be affecting TIP growth. But the whole focus is really on the left panel, what has happened so that we can explain this slowing down in GDP growth as well as capital growth. So of course, we are not the only one who is studying this remarkable growth and also the more recent slowing down. In the literature, you can roughly divide the literature into two strands. One, trying to understand these things from macroeconomic perspectives. I don't have time to give you a literature review, just let you know a lot of great papers on this. And also, the other strand of literature is more about the importance of institutions. There are also a lot of great papers on that. But how do we position our papers? We see our paper as a bridge that connects the two strands of literature. In particular, we try to build a standard macro model, and we try to introduce what we call Mandarin system or Mandarin model into this otherwise a standard macro model, and try to quantify some of the most important, we believe, the most important institutional features of the Chinese economy into this macro model. So let me briefly explain to you what do we mean, the Mandarin model. So in terms of economic structure, this is really just a hybrid economy of, on the one hand, you see a vibrant private sector, and on the other hand, you see a powerful state sector. And then here comes in the Mandarin system that has been ruling, China for thousands of years. So you see those resourceful, decentralized local governments, they are monitored, incentivized, and disciplined by the central authority. So this system has been there for many, many years. But the interesting thing is that the system itself has been evolving over time. Even for a relatively short period of time of 3 decades, this is what the paper is a study. And we can show you, there's some important changes in the system. So more precisely, we try to show you, once you introduce the system into the macro model, then, and study the decision of local governments, and in particular, local governments trade-off between their own consumption and investment, or more precisely, infrastructure investments. Once you start to think about this trade-off between your own consumption and investment, then you immediately see 2 important wedges. So the first thing is what we call investment wedge, which is very similar to the investment wedge in the business cycle accounting literature. The only thing is the micro foundation is completely different. And here we say, as I will show you later, this investment wedge is essentially driven by career incentive. Once the local officials, they understand, the central authority is going to give them more rewards if they deliver stronger economic performance, and then they're trying to boost economic performance. And the way they can do it in the model is to increase investment. So if they receive a stronger career incentive, they're going to invest more, even if the returns to investment are low. So that's essentially a wedge that pushes the local government consumption growth away from whatever the returns to infrastructure predicting in a standard model. And the second wedge is what we call the disciplining wedge. So the central authority, on the one hand, they want to boost economic growth, and on the other hand, they want to avoid troubles. In our model, they want to avoid the financial crisis. They want to avoid the local fiscal liquidity shortage. So they're going to penalize those local officials who borrow too much. Okay, so then it generates a wedge, what we call disciplining wedge, that makes local government consumption growth deviate from whatever the interest rate is predicting in the standard macro model. So we're going to use what we call the institutional accounting to identify the 2 parameters that we think can characterize the whole system. One is the career incentive parameter, and the other is the financial discipline parameter. And we can show you, the 2 parameters actually changed a lot over the past 2 decades. And the career incentive and the financial discipline peaked in the period of Jiang Zemin Zhuangji regime in 1998 and 2002. And after that, the 2 parameters are going down pretty substantially. And we're going to do some counterfactual. And the biggest message, I guess, is to show you, if you if you trust our model, then the model is going to tell us. If you take out the Mandarin system entirely, then the GDP in China in 2007 will be just half of its level in the data. So that's just a remarkable difference. So as I said, the stellar growth country will just become a normal country. And second thing is looking forward, we can also do some counterfactual. So suppose we're able to restore the strongest incentive and discipline in history. In the future, then what will happen? Well, the steady state GDP in China will be higher by 17%. It's also a sizable change. And the main reason behind this is once you manage to rein in local government borrowing, then you can avoid very large crowding out effect on private capital. And that's the key why the steady state GDP can be increased by 17%. I don't have time to talk about welfare implications, but just let you know, even if a Mandarin system that can deliver high growth, great economic performance, it doesn't really mean always welfare gain. So welfare implication really depends on some conditions. So I only have 25 minutes, so I'll be quick about these basic facts. Bernie, you have a question?
Yeah, just clarification. When you say the 17%, what is the time frame of this 17%? Long term or just immediate? Because now we're talking about macro, we have to think a lot about the time frame of these numbers. These
it's a steady state. In the short run, steady state. In the short run, you will see over the next 2 decades, the growth rate will be increased by 1 to 1.5 percentage points on average. But in the long run, the level of GDP will be increased by 17% in the steady state.
Thank you.
Okay, so the first thing is about the infrastructure. So China is not a high-income country, but if you compare China with those rich countries, including United States and EU countries, you will find that China actually has a relatively larger infrastructure sector. And this figure is just telling you cross-country comparison. We use a share of infrastructure capital in total capital, and the share for China is close to a quarter. In the US, it's 17 to 18%, and the average EU country level is 10%. So China really has a large infrastructure sector, and most of the infrastructure investments are actually made by local governments. So that's the first thing. And then the second thing is, which is, I think, much less well known. That is, how does the local government allocate the resources? So the figure, the black bars in the figure is telling us, well, this is a ratio of infrastructure investment in local government revenue. So see what the second black bar is for Jiang Zemin Zhongji regime. Well, they spend more than half of the local government revenue on infrastructure. That's really remarkable. But if you look at more recent periods, you can clearly see, well, local governments are shifting resources away from infrastructure. And now, if you think about the ratio as local government's average propensity to invest, then this average propensity to invest just dropped to 30 to 35%, so a lot lower than the peak level. And another thing is, we all know, government debt GDP ratio has been skyrocketing in China. So the black bars in this figure are telling us, well, local government GDP ratio really increased a lot. And if you look at central government debt GDP ratio, which is in the white bars, it has been quite stable, right? So the main driver for this growing explosive leverage ratio is really driven by local governments. And then the last thing is, it is also associated with much higher interest rate. so talking about interest rate is always tricky in China, but we're doing our best to try to estimate, market-based interest rate. I don't have time to tell you the details, but just let you know, after 2008, you see much higher market-based interest rate. That also means, a typical crowding out effect. So let me just jump to the model. I think just bear in mind that the two important assumptions we make. One is TFP growth. TFP level of growth are exogenous in the model. And the second is we assume exogenous tax rate, because local governments cannot change tax rate, whatever the tax rate, the central government is imposing on local governments. But the optimal choice the local government is making is about, consumption and investment, or, saving and borrowing. So here's the model. So the production side, we have a model with many regions, and each region is indexed by I. So YI is just local GDP, and G is infrastructure. GIT is local infrastructure, and KIT is like local non-infrastructure capital. Let's just call it private capital. And G and K are contributing to local output in Cobb-Douglas way. And we can entertain some externality of infrastructure in the production, but it doesn't really matter much for the results. And then we have the typical firm result. K is perfect. K is mobile across regions, but G is not. So when firms are making decisions, they take local G as given. So when you have more infrastructure capital in the locality, then you have more K. This is a typical crowding effect. However, if everybody is building bridges and roads, then it will push up, rental rate, and that will crowd out private capital and then have a negative effect on output. This is captured by this RK, which is the rental price for K. Yeah. So the next slide is household sector is extremely simple. We just have a 2-period lived OLG, just to make life simple, and we enrich the model a little bit by introducing warm globe bequest motive, and the purpose is just to generate increasing wealth to income ratio in the household sector to match the data, and nothing else. So it doesn't really add any new insight. So capital market is important. So when people save, they put money into banks, and this gives us a WH, which is the private wealth of the households, and that is the supply of funds to the capital market. And if you look at demand side, you have demand from the private capital, and QK is just a relative price. So why it is here is just we want to make good use of the data on the relative price of consumption goods and capital goods. And D is local government debt, and F is foreign reserves. And so if there's excess supply of funds, then you have reserves, and the interest rate will be just following the world interest rate. And if the capital market becomes tight, and then the interest rate will be endogenously determined, and this will pings down this equilibrium price of rental price of capital. Okay, so here comes the key thing: local governments. So the first thing is the local government budget, which is entirely standard. This is local government consumption, this is local government investment, and this is local government revenue, and this is their borrowing. Well, we have a little complicated structure for local government revenue, just to match the data well. We have the tax revenue, we have a transfer from the central government, we have land sales, and we have income from infrastructure services. But once again, this is just coming from the data. Here's the key thing. So how do we really model the Mandarin system? So the first part is this kappa. So kappa is what we call three incentive parameters. So it captures the rewards to, for instance, promotion, the rewards to promotion. So the idea is local officials, they understand central authority is evaluating them based on local GDP. This is something, you know, the central authority understands. And how are local officials going to react to that evaluation system? In our model, the only way for them to do it is to increase local investment, G. So that's why, you know, they understand if they increase a little bit G, then their promotion likelihood is going to be a bit higher, and therefore they're going to be rewarded by that. And how much they're going to be rewarded from that really depends on, you know, how big this kappa is. That just captures the rewards in the Mandarin system. And the other parameter is called financial discipline. The parameter is called the omega. So as I said, you know, the central authority also wants to avoid crisis. So here is this E. E is a leverage ratio, which is defined as the interest ratio of interest payment to local government revenue. So the idea is when the leverage ratio is higher, then it's more likely to trigger local fiscal local fiscal shortage. So once it happens, then local officials understand that they're going to be penalized. And how much penalty the central government is going to give to those local governments is captured by this omega. So we have some toy models to microfund these two things. But just let you know, well, here are the two institutional parameters that we want to quantify. Okay, so very quickly, just tell you how these two parameters are affecting our economic outcome. So one thing is this kappa, this career incentive. This career incentive, if there's no GE effect, the interest rate is exogenous, and then stronger career incentive is always good for the economy, because you know you have crowding effect, but you don't have crowd out effect. But once you have G effect, then it's possible you can generate some negative effect. And the same is valid for how, you know, this financial discipline effect is affecting outcome in a steady state. It turns out that the GE effect, the crowding out effect of the financial discipline parameter is particularly big. And in all the economies we try to calibrate the Chinese economy, we always find the same results, that the GE effect of this omega dominates the direct effect of the omega. So that's why, you know, tightening financial constraint on the local government in the long run is good for economic output. So I understand I don't have much time left. So be very quick about the two first order conditions. That's where our accounting exercise is based on. We're trying to calibrate kappa and omega. But how? We just use the two old equations facing local governments. So the first equation is basically determining how much money they're going to borrow from outside, how much money they're going to save, and the second equation is determining their investment choice. So we can back out, once we have the data, then we can just use the two first order conditions to back out two hidden, you know, institutional parameters. Okay, so that's a very rough idea, and the results. Okay, the results are pretty interesting. Well, this is gamma in 1998 to 2022, and this is gamma in 2013 to 2017. Well, in terms of intensity of financial discipline, it's 1/10 of its peak level. And in terms of career incentive, it's like 4% of its peak level. And much of the variation in gamma in this career incentive is coming from, you know, the changing allocation of local government budget, as I showed you earlier. Okay, so we can also apply this accounting exercise to the provincial level data. And one advantage we can do is we can do some external validity check. So for instance, the question is, of course, that these career incentive and financial discipline parameters will only matter for those local officials who are far away from their retirement age. So they still have a lot of potentials to go. And those things do not really matter for those who are close to retirement age. So that gives us an opportunity to check the validity of those accounting results. It turns out, quite interestingly, yes, those career concern parameters are indeed correlated with the average age of city leaders.
Oh. We have 1 minute.
Oh yeah, let me wrap up. This is actually the last thing I want to say. So surprisingly, these career concern parameters also correlated with the TFP growth. So at the aggregate level, the correlation is high, and at the regional level, the correlation is also high. So we can confidently rule out any mechanical reason leading to this correlation in the model. So what does it imply? It implies, we have underestimate the importance of the Mandarin model. In what sense? In the model, the only way for local officials to promote economy is through making more infrastructure investments, but there are many other ways. For instance, they can improve the business environment, they improve the local resource allocation, they can actually build a more independent judicial system. These are all the things that have been studied in recent literature. Okay, so time is really up, but one last thing. So if you take out the Mandarin system, then what will happen is look at the dashed line, the dashed circle. This is where China would be if you take out the Mandarin system entirely. So the standard growth would be just a normal country. So I have done some other exercises, but I don't have time to talk about it. I will stop here. Thanks.
All right, thank you, Michael. So our discussant is Professor Loren BRANDT from University of Toronto. 25 minutes.
Okay, and so let me share my screen. So you see my screen?
Not yet.
Okay, let me just, okay. Okay, where did it go? Oops. Having some problem. Okay, do you see my screen yet? My slides yet?
Not yet.
Okay, I may need some help here. I've done this.
Yeah, you can send the file through chat to me, and I'll share the screen for you.
Okay, and so how do I send it to you through chat?
There is at the bottom of the there is a chat. Do you see it at the bottom?
Okay, just give me a minute here. Sorry about this.
Mm-hmm.
Okay, I see the
chat.
I see share screen.
Mm-hmm.
Okay, I see chat.
You see chat, and then you choose me. You can send it to everybody, or you can send to me, and then send the file.
As an attachment?
Yes.
No?
Well, you can directly just send the file.
Wait, okay, I'm sorry. This is new. Okay, okay. I see it. Okay, I'm sorry. I just don't see how to.
You have this page, a paper that's you can send the.
So I'm just not sure why my slides are just not appearing on my screen. Kind of at this moment. Darn it.
Or if you can access your email address, you can also send that to our host.
Okay, good. I'm going to do that. That will be probably be the quickest thing. Just give me a minute.
Yeah. And then we can, if our assistant is here, I believe the host and co-host and Wang Xue, when you receive the email, please share the screen. Apologize for not being able to fix this before the session started.
No, I should have tried to handle this again before. Because I have a new machine, and so I've had some problems in terms of being able to.
And this gives us the time to think about the very insightful paper by Michael and prepare for questions.
So I guess I'm sending this to Jonathan Yip.
No, you're sending this to Wang Xue, the person who invites you.
Okay, so sorry. So Wang,
W-A-N-G.
Yes.
XUE at PBCSF.
Yes. Okay, fine.
Okay. Sent?
Yeah, just 30 seconds.
All right. Why don't
Just
you
a
have
minute,
it?
almost there. Just hold on.
Oh, you haven't said. All right, go ahead.
Almost. Okay, I just sent them.
Okay.
Okay. So I guess in the interim, I can go ahead and I can get started.
Yes, and the motion,
Okay.
when you receive it, please share the screen.
Sure, I'm still waiting for it.
Okay, so let me just get started. So, first of all, let me just thank again the organizers for the opportunity to be able to discuss the paper. Maybe 3 or 4 years ago, I was actually one of the referees again for Wei's paper. So it's just really nice to be able to go ahead and to kind of see this paper and how it's gone ahead and progressed. And in terms of some general comments, this paper, what I like about this paper is it just really tackles a first order set of issues. For those of us that are interested in economics, development, global economy, China's rise, kind of the slowdown that we've seen over the course of probably the last 8 or 10 years, there's just probably, again, no issue that perhaps is more important. And so in this paper, Wei, again, and Michael, again, are just trying to provide, again, some very important kind of insight, again, into the development that we've seen. So maybe the next slide.
Great, we're working.
Okay, great. Now, certainly from my perspective, as someone, who doesn't, work with kind of dynamic general equilibrium models, this is a really complicated paper. It has lots of moving parts. Kind of over the course of the last week, I've devoted a fair amount of time trying to work my way through this. And perhaps this is just my way of saying, look, I probably missed again some of the subtleties here. But I think this paper kind of takes some work, but it's also a credit again to Michael and Wei. What the paper does do is to provide a provocative explanation for the economic slowdown that also has really important policy implications for reigniting growth. And this is especially salient kind of in the context that certainly under the current leadership again in China, kind of this new priority on value-based legitimacy. And so what this paper is saying, hey, look, that if China really wants to go ahead and kind of accelerate and kind of reignite growth, that what it needs to do is to kind of return to kind of a system and a set of incentives, again, that had existed earlier. Kind of a last kind of more general point, in all of these papers, issues of data, estimation, and identification of key parameters are critical. And this is just true, again, for the macro development models more generally. Next slide, please. So just again, a little bit of motivation, as Michael had gone ahead and done kind of at the outset. What motivates this paper is just this kind of graph here. And that we see over the course of perhaps the kind of the first 3 decades of growth, we see relatively rapid growth. But over the course of that period, probably since the mid to late 2000s, that we see a kind of a relatively sharp decline. These estimates, again, are just kind of based on kind of the official data. If we were to look at, slightly more, other kinds of estimates, perhaps the growth is even slower, a little bit lower, and maybe the rate of decline, again, has been even more rapid. Next slide, please. But what's important that when we take a look at this growth, and Michael alluded to this, is that what's underlying this growth is a fall, in TFP. And so this kind of very rapid growth in TFP, or the rapid growth in TFP that we observe through the first 3 decades, again, of growth, again, this was just extremely, again, important. It contributed directly, again, to the growth that we observed. It also helped to maintain relatively high rates of return to capital formation, especially, again, in the private sector. And if you do the kind of Barrow type calculations, then certainly up through the first 3 decades, productivity growth was probably the source of about 3/4 of all the growth that we happen to observe. Kind of in sharp contrast, we see this decline in productivity growth the last decade or so. And so the contribution that productivity growth, again, is making to this growth that we observe, it goes from maybe 75% to maybe even 25% or even lower. But what's also important, again, in the context of this productivity growth, is that given that the kind of the state sector, the share of the state sector has been relatively constant certainly over much of the last 15 years or so, that what that really implies is that a significant contribution or source, again, of this declining productivity growth that we actually observe over this period is actually the private sector. Maybe skip again. Next slide. Okay, yeah. And as Michael alluded to, perhaps kind of the other kind of important kind of stylized fact just has to do again with what's been happening to rising debt. Now, there's all kinds of kind of alternative explanations for the behavior that we happen to observe.
I think you should go back to the debt slide.
That's okay. This one's fine.
Oh, okay. All right.
That there's all kinds of alternative explanations for the falling TFP and growth. Michael and Wei are going to provide kind of their own kind of interpretation, but we just kind of want to recognize that there are alternative interpretations. One just says that, hey, over the first 3 decades, China was really successful. They kind of narrowed the gap in productivity with advanced countries. After the global financial crisis, global TFP trends again begin to kind of come down. And so, well, perhaps maybe some of the slowdown that we've observed is just kind of a reflection of China's success in narrowing the growth and a decline in global TFP. An alternative, explanation, and you see this again, it's often kind of discussed in the press, this has to do with kind of the limitations of an investment-led growth strategy. Here, these kinds of commentators would be much more inclined again to see China's growth through the first 3 decades as being a consequence of some kind of investment and perhaps export-led growth. But here again, in this context, and especially in the context of the shock of the global financial crisis, that China perhaps again tried to offset some of the negative effects again of that shock again on growth through increases in public investment. Well, this had relatively low returns again. Much of this investment had relatively low returns. This spills over into the property sector, problems of rising local debt. And that in these kinds of interpretations, again, the problem is, in fact, there's too high of a weight of growth, again, on the cadre evaluation system. And that's kind of seen as a major source of a problem. The alternative explanation, again, that one might offer for the falling TFP and growth really has to do with the kind of shift in policy that we see over the course, of the last, 15 years. And so that in contrast, if we thought about those first 3 decades as being a period of kind of bottom-up decentralizing reforms, policies, again, that contributed to both increases in autonomy and incentives for households, for firms, for local officials, internal, external liberalization, increasing competition. Those were the things that were just so important to the first success during the first 3 decades. But over the course of the last 10 or 15 years that we've seen a reversal. And so in that context, then a lot of the decline in growth and the TFP that we observe over this period, is a consequence of a shift of policy. So it's just kind of important to recognize that there are alternative explanations, again, that are out there. And that one of the things that we really want to do is to try to kind of identify, again, which of these explanations is perhaps most important. Next slide, please. So did we forget? Okay, yeah. So in this paper, then, kind of the key conjecture of this period, and it's going to be providing this explanation again for the kind of the decline in growth that we that we observed during this period, is that all the focus is going to be on what's happening to career incentives, and that after this first 3 decades of reform, where there were this relatively strong career incentives that were facing local leaders, these things again are diminished significantly. That again combined with the relaxation of financial discipline, these things are effectively kind of weakening the link between economic performance and career advancement. And so one of the things, again, to note here is that this kind of interpretation about weakening incentives, again, facing, again, cadres and officials, in some sense, again, kind of on the surface seems to be at odds with these claims that others have made that the more recent problem really has to do, again, about growth at all costs. And that, in fact, there's too large of a weight, again, on growth, again, on cadres and officials. And so clearly the policy implications are just important. And so what it says is, hey, really what you need to do if you want to kind of reignite the growth is that you need to kind of restore, again, these incentives, again, that we saw in earlier periods, and perhaps slightly less important, what we want to do is that we want to increase the discipline on local government. Next slide, please. So Michael has done, again, kind of a good job in terms of kind of highlighting the key features, again, kind of the model here. We got firms, we got households, we got banks that are intermediating, we got local government. But the real focus here happens to be, again, on local leaders. And these local leaders are important, and they're important in terms of the decisions that they happen to be making. And these decisions, are going to be with respect to local infrastructure investment. So that from the perspective of the local leader, have these resources, again, that happen to be at their disposal. In principle, they could use those resources, again, to the benefit of government workers. Alternatively, if they happen to be concerned about career development, they can direct, again, those resources to local infrastructure investment. And so these career incentives that these local leaders happen to be facing, these are just going to be central, again, to the analysis in this regard. The more important, again, these incentives are going to be, the more, again, the local leader is going to be directing, again, these resources to local infrastructure, because, again, this investment in local infrastructure is effectively going to be a signal to the higher levels of government about the ability, again, of this local leader. And so that's going to be extremely, again, important in terms of their kind of career considerations and concerns. So next slide, please. So what's kind of critical here then is just going to be this institutional accounting, again, that Michael has gone ahead and referred to. These leaders are going to be making, again, this kind of some kind of optimal allocation, again, between expenditure on infrastructure, as well as benefits, again, to local rulers, or local expenditures, again, benefits to workers, again, in government. But the two kind of key institutional parameters, again, are going to be influencing in this optimal choice, from the perspective of that local leader. And so what they're going to do, as Michael said, they're just going to be using these Euler conditions to effectively back out then what these wedges were and what the two key parameters are relating to the career incentives and the discipline. And the little kind of table below, which I've taken, again, directly from the paper, just goes ahead and kind of shows you what's happening to both kind of this discipline wedge that Michael talked about, the investment wedge, and the underlying, again, parameters that relate to just, kind of how important these kind of career incentives are. So the extent to which promotion happens to be tied, again, to the ability and the performance of that local leader, and how important this financial discipline happens to be. So you can see that the discipline wedge, the investment wedge, similar levels, they kind of move kind of similarly through time. But what's also important with respect to kind of the other two kind of critical parameters, you can see again that how these things happen to be rising through time. So effectively, the kind of the financial discipline kind of is increasing kind of early on through periods 1 and 2. Kind of the weight in this case, again, on kind of career advancement, that happens to be increasing, over time. But then you can see that after this initial increase, very early on, you can see kind of the long-term decline that we happen to see, both in terms of these kind of career considerations, kind of the career incentives, and then as well, then also kind of financial discipline. Next slide, please. And so these things, again, are effectively going to be what's kind of driving things. And the kind of in the analysis, there just ends up being a strong correlation between these kind of career incentives and future economic growth. And so I think that Michael had already gone ahead, and presented, again, this slide. So next slide then. So in terms of kind of my kind of thoughts and in terms of feedback, I think they're going to kind of fall kind of in kind of three kind of general areas. The first just really kind of has to do about, how important are career incentives to growth. There's just an enormous literature, again, kind of that has emerged, over the course of the last, probably 2 decades, again, that's tried to kind of relate China's success to the nature of the incentives, again, that cadres and officials happen to have. And, the more that I read, I just sometimes wonder, again, have we perhaps put too much weight, again, on these considerations? And so that, in a variety of ways, again, we know that local leaders happen to be motivated by just all kinds of things that often limit the dynamism and that constrain growth. We know that loyalty is important. We know that rent extraction happens to be important. We also know, again, that support for the state sector, again, happens to be extremely important. And, in work, again, that I've done with Georgi Kambarov and Sheryl Storch-Sledden, here again, the size of the state sector ends up being, extremely important, in terms of the kind of the barriers to entry, again, that private firms are going to be facing kind of at the prefecture level. And I mentioned the state sector, again, in this context as in part kind of being a huge kind of constraint, again, on the growth process, because much of this infrastructure investment that Michael and Wei happen to be talking about, this is in fact occurring, again, through kind of state-owned companies and state-owned firms. So first, again, are we maybe putting too much weight, again, on these considerations, just recognizing that lots of other things, again, are going to be important and are going to be entering into the calculations that these local leaders are going to be facing. The second point, it has to do, again, with measurement error. And so this is going to be measurement error both in GDP, and investment. We know as we take a look at data for the 80s and 90s, we know that local level data, we know that it's inflated. So we know that, provincial level data never add up to the aggregate totals, and people in the NBS have to do all kinds of adjustments to kind of reconcile, again, these estimates. Clearly, again, it just has to be the case that this kind of measurement error that we observe in GDP and investment is reduced in the signal to noise ratio. It's making inferences about leaders' ability much more difficult. These problems have always existed, but what I would argue that these problems, I think maybe Michael would agree, that these problems in the national income accounts have only increased over time. and that we also see kind of an enormous amount of heterogeneity in terms of these kinds of, in the measurement area in GDP and investment, across localities. And so one of the implications, again, that this happens to have this kind of measurement error that just seems to be so prominent. Well, maybe it's the case that higher level, government officials are just filtering this information that we don't know. They know that these are very kind of noisy signals. Well, if they do, well, that certainly has implications for how do we interpret the results. But maybe, again, if they don't, maybe if they just use, again, the exact same numbers that we're using when we run these regressions, maybe they're putting too much weight, again, on a signal that's easily manipulated. And if that happens to be the case, and we get this kind of strong correlation between these measures of economic outcomes and measures of economic growth and promotion, well, maybe again, it's going to be the case that not the best, are promoted. So first, again, kind of concern, again, just has to do about kind of career incentives. Next slide, please. And so just maybe to kind of reiterate this point, again, it has to do, again, with output, again, as a signal of ability. Just taking, again, a number of quotes, again, from the paper by Wei, again, and Michael, where one, regional output's the most reliable of the statistics. Second point, again, is regional output is mostly generated by private firms. It is more difficult for a local government to inflate the regional output. Next slide, please. And just perhaps kind of in counter to that, to just in work, again, that, with colleagues, again, that we've been doing, one of the things, again, that we observe is that certainly since 2007, problems, again, of over-reporting seem to have gone ahead and increased. And so this is especially, again, going to be the case in manufacturing. And so we can see it, again, in firm-level data. It's problems, again, that kind of aggregate up to the macro level. So huge differences, again, in terms of the reporting numbers that we see to the NBS versus to the statistical authorities. It's increasing over time. There's kind of a clear kind of geographic component to it. And you can kind of identify, again, you can see these provinces in red where the over-reporting in 2007 was higher, but also by 2013, it was even larger. Next slide. And moreover, that this is a problem that tends to be more severe, at least is most severe for private sector firms. So kind of on the right, you can see the problem of over-reporting, SOEs, Hong Kong, Macau, Taiwan, non-SOEs. And so this is a problem, again, that seems to be especially severe amongst private firms. So there's both a regional component, there's also a problem with respect to private firms. And so just kind of this more general point, how accurate, again, is, output going to be a signal in terms of the ability, of these local leaders, again, in these kinds of tournaments that we talk about. Next slide, please. So the second kind of set of second points that I want to make, it really has to do about the identification, again, of the key wedges. And this is going to be true both with respect to levels and changes. And these kinds of issues are going to arise, in the context of these kinds of models. And so to me, again, one fundamental question is, what is it that's actually identifying the wedges? Can they be separately identified? In other words, again, are there kind of a unique set of variables, again, that are helping to identify the investment wedge from the discipline wedge? Moreover, that when we take a look at these wedges and how they happen to be behaving over time, is that one of the things that we can see is that the behavior is identical in terms of how they kind of behave between the late 90s, all the way to the, mid to 2015 to 2020. In fact, it turns out there's a good reason why that is so, because it turns out that the changes over time, again, in these key wedges are in fact driven by the same thing. And that both, again, of the changes in these things are driven by local government consumption. And so these two things, again, behave similarly, as do the key parameters relating to the career incentives and financial discipline. And so all of that just makes it, again, a bit more difficult, again, to be able to kind of sort things out and the effect, again, that these wedges are having at any given point in time, as well as their changes are having, to the behavior that we happen to observe. And remember, again, what this exercise is all about is trying to kind of link the changes that we see, again, in these parameters to, again, the behavior that we observe in terms of the output that we happen to observe, again, over time. Next slide then. So finally, again, my last point is that, here they focused, primarily, again, on infrastructure, but what about what about housing sector? And so to me, again, that these two kind of, the housing sector is hard to ignore, certainly in the context of talking about infrastructure, that its share in terms of gross domestic capital formation is very similar with infrastructure. There's all kinds of links, again, between investment and infrastructure investment related to the supply of housing. This has huge implications for land prices, government revenue through land sales. And so housing and infrastructure then are also just kind of linked through problems in financial markets. And so next slide. And so that when you take a look in terms of kind of how important housing investment happens to be, and so if you kind of take a look at the slide kind of on the far right, blue happens to be the share of gross capital formation that happens to be going to housing. The orange happens to be that's going to infrastructure. Certainly by 2014, 2015, the share of investment that we're going to these two things, again, were in fact fairly similar. Numbers for 2023 suggests again that similar shares were going to infrastructure and housing as well. So in this kind of context, to me, it's very hard, certainly in the context of local governments, to talk about infrastructure investment without also talking about housing investment. Those two sectors, again, are linked, and it would be nice, again, to learn more, again, how they happen to link and what the implications may be. And then kind of last slide. So my last, again, point just really has to do, again, about problems of inefficient investment, and that what we see kind of over time, my own kind of take in terms of a lot of the decline in productivity, is that we're probably seeing declines in productivity of both public investment, but also private investment. That we see, for example, a decline in productivity in firms, in private sector firms. Here, I just took this from, I think it was in the Wall Street Journal yesterday, that talks about factory capacity utilization rates in China. And you can see, again, how these things have declined significantly since, again, 2017. And so we see, again, these kinds of problems in terms of inefficiency, in investment. It's not only inefficiency in public sector investment, but it's also inefficiency in private sector investment. And so any kind of explanation, again, that we want to offer, again, for why we happen to be observing, again, this kind of decline in productivity, the decline in growth that we are observing, really has to be able to tackle, again, why we're observing declines in productivity growth in both. So those, again, my comments here, but in general, this is a wonderful paper. And Michael and Wei just really kind of pushed things forward and just given us a lot of things to think about. So thank you.
Thank you, Loren. And before I open the floor for questions, I do have an announcement to make. Then we can go on to Q&As. The announcement is for the ABFER webinar for May, we will have a pause because we will have the annual conference at ABFER. So there's no seminar in May, but we're back in June, and the paper will be presented there will be technology, legal reforms, and bank lending evidence from online court auctions. The authors are Huang Yi, Peng Yuchao, Sun Yangfan, and Bernie Yang. Okay, now I'm ready for questions. Or, Michael or Wei, you want to respond briefly?
Well, yeah, let me just give a kind of quick response to Loren's questions. Thanks a lot, Loren, for these fantastic comments and thoughtful feedback. I think I agree with you completely on most of the points you made. In particular, we should take out the sentence you put up onto your slide. The private sector are less likely to be affected in terms of data manipulation, and this is also what we found recently. So I completely agree with you. I think that statement should be taken down. But on the other hand, I have been following these statistical issues closely in recent years, and I think we are doing our best to try to correct those issues, and we actually found our results are pretty robust to whatever corrections we made, and also identification. That's a really key issue. I think we need to explain better in the paper. So most of the variations in kappa and omega are coming from, the changing local governments' average propensity to invest as well as the interest rate we see in the data. So I think we can clarify that later. For housing, yeah, definitely we can do that. So far, housing is just included in this K, and K is complementary to G, but we can do a better job. So let me stop here. We can talk more later.
Anyway,
Yeah, maybe I can add just one thing about this over-reporting. In fact, actually, in the early version, which Loren you read before, we actually have a specific section to talk about the over-reporting, right? Because under Korea incentive, clearly local officials have incentive to over-report, and just like in Holmstrom's, the Korea concern signal jamming mechanism, right? So these are totally anticipated. And actually in the performance review will be filtered out. So it doesn't really affect review, but the officials will end up doing that anyway. So I think sort of, so conceptually, this doesn't present any problem. This is well anticipated. And exactly actually, that's what you see, right? Many provinces did that anyway. So, but on the other hand, does this really, this does not necessarily mean that the create incentive doesn't matter, right? In fact, that means actually matter much. Right. So I think sort of that, yeah. So the other thing, yeah, Michael already responded. I think we should open up.
okay, all right. So Bernie, what's your question?
Yeah. By the way, let's first point out that the next seminar will be in July, not in June. So Yiwan will present on the 3rd week of July on third Thursday. So I'm taking the perspective that Michael and Wei are trying to build a disciplined model to look seriously at how government incentives from the central to the local with a composite weight, and the shifting composite weight can affect the macro behavior of the economy, and use that to explain perhaps the observed patterns in the total growth, in the TFPs, and so on and so forth. So what I see is that also Loren is giving us a very comprehensive and a very general comments on many of the things that we need to pay attention to. But however, I feel that I'm very sympathetic to what Michael and Wei are doing, because in doing very serious economic, it's always good to take a disciplined approach with a more narrow focus to identify some of the things that we surely know that go beyond just the generalist comment on here's what go wrong, what can, etc., etc. So in that spirit, let me ask my question. Well, let me pitch my question in the following way, hoping to solicit from Michael and Wei the very deep in a contribution they're making. So when it comes to incentive and giving multiple component incentives, and also giving the local governments instruments, I remember that many years ago, there's Zhou Lian's thing about growth tournament. And later on, then is the Morgan Young talking about the big push, and the government is incentivizing the local to just grow, and also with other components of the incentives, and giving them the state-owned enterprise and also the banks, to as the instruments to achieve the growth, to participate in this growth tournament. And some of the objectives could be about the control for the environment, etc., etc. So these models that I just described are very verbal model, and including like my review of finance paper, it's just verbal model. And what is unsatisfying for my kind of verbal model is that we miss a lot of important things that your kind of model can achieve. And now what you're saying at this point is essentially at the beginning, the government push for growth tournament, and now the government push for fiscal discipline, deleveraging. These are general comments. But your model gave us something more than that, I believe, after all this hard work. Can you elaborate on what your work can help us to achieve that the generalist may not be able to accomplish? In other words, I'm really asking, what are you giving us after all this hard work, and I believe it's there. I firmly believe it's there. The disciplined approach.
Okay.
So Wei, would you want to
Okay. Let me
try
give first a
first?
shot. So then, you know, in my mind, is sort of, you know, China is a complex, you know, growth mechanism, right? So it's not the planning economy, it's not the free market, rather it's a hybrid. So actually, this also relates to Loren's discussion earlier. So that, you know, Loren emphasized quite a bit about TFP growth, but of course, TFP growth is actually, in my mind, is always sort of a combination of the two, right? So the state trying to promote growth and trying to provide the necessary environment, not just infrastructure, but also actually probably even more important is sort of the soft business environment, right? So that private firms can be more productive, they can be kind of, you know, feel being supported and all that. So it's really the combination of the two that had led to the past rapid growth. And lately, the slowdown. So in this paper, we emphasize quite a bit because of the local government priority changed, right? So as a result of that, this had caused the sort of support from the state side, you know, reduced. But of course, I think when that happens, this also affects private firms' efficiency. So basically, sort of, I think it's this interaction, right? So when you're working, they amplify each other, so make each side more effective. But when sort of the environment change, when the state side incentive reduces, that not only leads to less infrastructure, but also leads to less support to the private sector in general. So I think our model, so this is a framework one can sort of, you know, discuss all of this together, right? So of course, right now we emphasize one side, but I think sort of more can be done. You know, given that there's this, the framework actually allows one to jointly consider this. And of course, sort of, we're trying to make this quantitative, so then one, you know, can actually even do this institutional accounting, right? To back out the parameters and look at the parameter, do they look reasonable, and whether you can use these parameters to connect with other mechanisms. So I think sort of, to me, I think sort of what's nice is that we now have this framework and potentially be expanded for other exercises.
I'm going to ask
Michael,
before you answer, I'm going to push this a little bit further. Like one advantage of this is that you can use your results to calibrate, to ask questions whether about the generalist comments can be validated or would that be exaggerated and so on. And also, I want to ask if it's possible to incorporate some of Loren's comment, but not all of them. If you incorporate all of them, you're committing suicide. But what if you just if you just incorporate maybe the housing, or if you just incorporate about an additional level of policy consideration because the central government itself is making a lot of policies.
Yeah. So let me just say a few words on this. I think, you know, Bernie's comment touches upon a fundamental issue. You know, what we are doing here. I think it's related to Loren's question. You know, he asked us about identification. So I think, you know, it's just two mirror images of the same thing. Although one is more like at high level, one is more at technical level. So a lot of things that we want to study are unfortunately not directly observable. So, you know, it's easy to say some narratives, but they're very hard to nail down the thing. So fortunately, it turns out that in this context, the key thing that we are using to infer, you know, all these incentives and the disciplines is, you know, the changing government allocation, local government allocation of their resources. So this thing has been pretty transparent. So when you see local governments are making more efforts in, you know, infrastructure projects, then it means that they care about the economy. And when you see they shifting resources away, they are less concerned about the economy. So I think this is something observable, and that thing, once you put that thing into a model just to discipline, controlling for returns to infrastructure. One explanation, of course, is TFP is going down, TFP growth is going down, and returns to infrastructure are declining, and therefore, naturally, the reasonable response is you're going to cut infrastructure investment. But we see this is not the case. Well, even if you control for infrastructure returns, then you still see kind of big change in infrastructure investment that cannot be well explained by these factors, and that tell us about something going on. So to me, I feel like this is a nice way to quantify this incentive that cannot be identified otherwise. And also, the advantage of the model, the macro model, is we can throw in throw in some of the thoughts to do counterfactual and to quantify how big is the effect. Yeah.
Myself. But Barney, go ahead.
Yes, as you're talking, I was trying to type to the two of you. I mean, one of the power of the model is the counterfactuals. Can you highlight just quickly so that Xiaoyan would get back her time? What are the most impressive counterfactuals that you obtain in this exercise?
Okay, so let me take this. So I think two takeaway messages. One is incentive is really important for the past success of China. So if you shut down this extra incentive, then infrastructure investment will be a lot less, and private capital will be a lot less. So that's critical. Even if the TFP growth was very fast, but without capital, that is still not enough. And second is looking forward, as I think Loren actually did a very good job, in telling the audience what we did, especially the part I didn't have time to present. So if we manage to restore the level of incentive we see in the past, then I think we can still have a long way to go. Yeah. Oh, let me just stop here. Xiaoyan.
I have a question. We have 2 more minutes left, and I have a question. My question is, your sample period stopped in 2017, and then my understanding is you guys are trying to explain what happened over the past 20, 30 years. Now I have 2 parts question. The first is, if you extend to 2023, you think the major results will hold? And then my second part of the question is, what do you think should happen, if we really, I remember Wei in his other paper said there are 2 goals. One is growth, one is stability. So, but in the future, what should happen? What do you think, in your opinion, what will be the most important thing to happen? Yeah.
Let me take the first question.
Maybe you go for the first one, I go for the second one.
Yeah, exactly. Well, we did something using the most recent data. It turns out these things are pretty stable, actually. So, yeah, let me just end here. And Wei, you have more time to address the second and the more important question, I guess.
Well, I think so. This question can take the whole day, right? So I think so.
Yeah,
but my
the most
answer
important
is
part.
right now. So last few years, too many goals, right? So the government has set up too many goals, which actually reduce the efficiency. We know when there's a single goal, the efficiency is highest. When there are too many goals, actually, nothing gets down. So that's the trouble. So I think you eventually have to go back to the single goal, which is the growth. So the other things will be taken care of by itself when growth is there. So there's no need to worry about it. Right, but worry about all of these goals at the same time, just causing coordination challenges, right? Because every agency feel its agenda is the most important agenda, then there's no coordination. So which is the trouble we face now, right? So now
Mhm.
the Ministry of Housing thinks the most important thing we need to support the housing real estate, but the central bank thinks financial stability is the most important thing. Why should we sacrifice bank security to support housing, support real estate developers, right? So then there's no coordination. But once you say the growth is the most important thing, whatever it takes to get growth back, then I think everybody knows what's the most important policy to adopt at this point, right?
So I
Thank
just
you
have
for your
one kind of last,
wisdom.
if I
Yeah.
can, just one last kind of comment again for Michael and Wei, and this is mainly just arguments to take on, especially amongst political scientists. I mean, they seem to just be wedded to the view that the problem is that the incentives and the emphasis put on growth has in fact been too high. So what they're going to argue is that kind of in the context of the global financial crisis, you get this kind of decline in TFP. You know, maybe TFP continued to come down because of more top-down policies. They're concerned about growth. And so what they continue to do is that even in the face of this declining TFP, that they look again and they use these instruments that are at their disposal. One of the instruments at their disposal is all this investment in infrastructure. And so we know that lots of that investment in infrastructure that we've observed over the last of the decade, lots of it is excessive, lots of it happens to have a relatively low return. And so what's underlying that kind of perspective is that there's too large of a weight, again, on growth, not too little. And I think that that's, again, a very kind of popular kind of argument out there. And if there's ways in which you can kind of address that, cut that off at the pass and present yours again as the alternative, I think that's going to be extremely important because you read the Financial Times, you read Foreign Affairs. This is the kind of narrative that just kind of runs through those kinds of pieces. And so it's just a continuation of this investment-led kind of model where growth at all costs. And that's really suggesting that these cadres are being awarded on the basis of growth in that regard, even if this growth happens to be contributing to declining productivity and has relatively low returns as we move forward.
Right.
There's
So
also
I certainly agree. Yes, I certainly agree to that concern. Right. So I think so this issue is not directly addressed in this paper, but actually I've been working on sort of other projects to kind of related to this. As I mentioned earlier, so the model is really about this complementarity between state intervention and the market mechanisms, right? So actually for this complementarity to be most effective is not to have sort of a more strong-handed state intervention, right? But rather state intervention to a certain degree, right? So I think sort of there's a boundary. So once sort of intervention cross the boundary, so you will actually, it will become decreasing return to scale, right? So eventually, so this coming down. I think sort of that's where sort of I think that there's this limit to it. Right, clearly, sort of, we need to make sure. So when it's within limit, actually, this can help to promote market mechanism and the efficiency of market mechanism. I think so. Whether sort of 20 years ago was too much or not, I think this is a quantitative issue. I think this requires sort of we have a framework more, maybe even more kind of build up to address this issue, right? But clearly, we're sympathetic to that argument, right? This is indeed a big concern.
Yeah.
But at the same time, I think sort of once this the incentive gets too much distracted to other things, they're not even really paying attention to growth. I think sort of they're not helping the market. I think that the point is here. The target should be growth, but on the other hand, not necessarily growth by investment, right? There could be growth by supporting private sectors, right? So in fact, actually, that's ideally the way to do it, because actually look at the sort of the most developed regions in China, right? So those are not necessarily the region actually have the highest state-led investment, right?
Yep.
But rather actually is the kind of a less developed area in the western part that did a lot of that, because the TFP is low and the local governments cannot find a better way to do it, right? So I think in that sense, actually, they didn't find the right way to do it. But the part that they actually find a way is not necessarily you have to use all this heavy-handed state-led investment. I think sort of again the goal is to grow the economy, but not necessarily means that you have to invest as much as you can. Even in our current model, the idea is not to invest as much as you can, right?
Okay,
Sure.
okay, all right. So somebody is going to tell me afterwards that you being a horrible host. Okay, you guys, I obviously think you have a heated discussion and productive discussion, and then it's already 11 p.m. for Princeton and Toronto. I will allow Bernie, you can ask a 10-second question. I'll finish in 30 seconds. If you have one more question.
Sorry, say it again.
I can give you at most.
Oh, no. Well, thank you. I just want to take the opportunity to thank the chair and all the authors and the discussions. This has been really wonderful. And we end up with something about talking about the policy direction, implementations, and so on. It's clearly that we are getting into a very enthusiastic and stimulating debate and discussion. Thank you very much. My request is whether, Loren, you can share with us your PowerPoint so that we can post your really thorough and very in-depth, insightful discussions onto our website. And that's all. And one more time, thanks to everybody, and hope to see you the 3rd week of July. Thank you very much. And also, if you can, please make it to the Singapore meeting. Thank you.
Well, thank you, Bernie.
Thank
and
you.
That's all. We had a great talk. I really learned a lot. And so that's the end of the session. Thank you.
Thank you, Loren, for a wonderful
Okay.
discussion.
Thank
Thank
you.
you,
Thank you.
XIONG, and thank you, Bernard,
Thanks.
for organizing.
And thank
Okay,
you. And so
bye-bye.
Michael, when I see you in a month or so, I'm going to have lots of questions and I'll pick your brain. So you can help me with this. You can help me with the subtleties.
I will be ready.
Yeah.
Okay, great.
All right.
Thank you very much.
Bye-bye.
All right,
Bye.
bye-bye.
Bye.